you so much for coming tonight. My name is Nikki Chani, and I'm the Executive Director of the Crypto Value Association, your host tonight. We are, if you don't know us yet, and I really hope that you do, we are the largest professional association in Switzerland, connecting the crypto and blockchain industry, and building the ecosystem here in Switzerland and globally as well. And this event is a testament to the strength of our community. We have amazing speakers today. 3/4 of them are CB members. And Martin has traveled all the way from London to host this event tonight. So we're really glad to have him here and all of you. Thank you for coming. Martin, the floor is yours. And thank you for
very much. Does that work? I have no idea. I hope you can hear me. So yeah, good evening and welcome to our panel. It's great that you're all here, and thank you, Nikki, for organizing the whole thing, and thanks to the CBA, very much appreciated. So I'm the moderator today. My name is Martin Leinweber, and I'm working at MarketVector Indexes. We are doing digital asset indexes since 8 years now, and I think what most of the people here know, we are not crypto native. Yeah, so we are doing every asset class, and we are in the nexus of TradFi and crypto, and managing almost 60 billion in licensed assets under management. And I think that brings a unique perspective, and perspective is everything. We could have named this panel not beyond Bitcoin today, but just Bitcoin, given the markets are crashing so hard. And I think that's the topic of today: how to diversify. Are there solutions in play? And I think it's really important not to over-concentrate your portfolio. And I'm glad that I don't have to do that alone. So I have really great experts here sitting next to me, coming from the largest crypto native companies in Switzerland. I think let's do a short intro first. Ladies first, please. So I hand it over to you.
Thank you, Martin. My name is Jasmin. I work for 21 Shares since about 2.5 years. We are a crypto ETP and ETF issuers. We are currently managing a product suite of 55 products with 10 billion assets under management globally.
All right, let me continue. Hi guys, I'm Dennis. I'm from Bitcoin Suisse. So we're, I think, one of the oldest companies from crypto here on the panel, currently residing in Crypto Valley. So we're, of course, very crypto native, you could say. We have 3 main business pillars, so anything from crypto trading, broker, custody, also staking. And then where I'm residing in Bitcoin Suisse, basically the invest and advice team. So we're currently building out asset management. Some of the colleagues are also actually here in the audience. And yeah, I'm basically doing anything from investment strategy, research, and advisory at the company.
Good evening, everyone. Thank you again for hosting this evening. It's great to be here. I'm Carlo. I'm from AMINA Bank, formerly SEBA Bank. I hope I don't have to say that too long. I, like a true investment banker in my previous career from South Africa, hedged my bets. So I have 2 roles at AMINA Bank. I'm heading up the investment solutions business, where its main pillars are the ETP, discretionary mandates, as well as structured solutions. And on the other side, my day job is really part of the derivative trading desk. I'm in a sales and structuring capacity. I've been with AMINA just under a year. And yeah, looking forward to this engaging discussion.
Thank you very much. Yeah, I think we have to touch on the markets, given how severe, especially the altcoin market crash is. Nowadays, you prepare the panel and you think you might have an altcoin rally, and here we are. It's the opposite. And let's start with Dennis. I know that you published something on the crypto super cycle. So I ask you, is that still valid? Is the cycle broken?
I mean, to clarify, it started out, I was asked on a super cycle, so it wasn't my idea. Okay. But I basically, to give some background ideas, I basically said if any cycle could be super cycle or we see mass crypto adoption, it would likely be this cycle. And I still think that holds firmly true on average, right? So given also how we see basically a lot of dynamics globally change, liquidity, etc., the markets have not been that great for some time. But we also know crypto has actually been on a rally ever since, especially Bitcoin, right? We see the administration change in the US, and under the last 4 years, basically, crypto has been always, let's say, marginalized. People have been unbanked in the industry, and that has been a full 180-degree reversal now. So I think if we actually will see positivity in the crypto markets, right, also in terms of performance, then I would say the chances the highest that it will be this cycle, or also our optimism then throughout this year, especially mid-year, we really target more positive markets again. And I think also then once we know new economic directives, trade wars, tariffs, etc., all that's going on currently with the new administration, there's some volatility in the markets, but overall our optimism, I would say, for this year is still there. And yeah, let's hear from the others maybe, but I would say overall we stand behind that statement. It will be bullish year and we will see new all-time highs.
Jasmin, what's your opinion?
I think I agree with you, especially what you touched upon, the regulatory changes in the US. So we have really a pro-crypto administration, which of course in the implementation phase leads to higher volatility. But overall, I think everything what you said, I can just second. We see more institutional adoption with the Bitcoin ETFs launching last year and the Ethereum ETFs launching last year in the US. And this is also a sign for the market that this asset class is going to be maturing.
Yeah,
Yeah.
I mean, absolutely echo the sentiments mentioned. I think, with recent events with private hacking, you can see, particularly with Ethereum, there's been a support resistance level there. So it's shown some sort of robust, maturing ecosystem that has held its value relatively. So agree with my fellow panelists as well.
Okay, so there is some opium there, at least. That's good. When it comes to diversification, I think a lot of people make a lot of mistakes when it comes, especially to altcoin investing. And I know you said it, Jasmin, 21 Shares is a lot of products out there, a lot of single tokens, but also basket solutions. So how do you help your investors approaching this whole field, selecting coins?
Yeah, maybe we need to go a step back here. So if you want to construct a crypto portfolio, there's generally two ways. So you can construct your portfolio yourself or you can invest in a basket. So when you do the portfolio construction yourself, you can almost do it as with a traditional portfolio, let's say a 60-40 portfolio. And instead of having bonds as a 60% or 50 to 70%, you hold the blue chips, Bitcoin, Ethereum. Then you have 20% in growth crypto, something that is maybe also thematic. And then for the rest, there is still some space for asymmetric bets or for high risk or unknown players that only came onto the market recently. So that way an investor can really target what they want to have and calculate their risk metrics to it. And we offer, as you said, I think by this point, 32 different single asset underlyings. Important to say here is when we launch a product, it goes through a very diligent due diligence process. So we look at the use case also compared in the peer group in the sector that this cryptocurrency operates in. We look at the liquidity and we also look at the regulatory viability. Another alley is to go via an already diversified basket. And there you also have different options. You can go through a market cap weighted basket, you can go through an equally weighted basket, or you can go through a sort of more sector-based approach. And I want to highlight, because I said 60-40 allocation earlier, I want to highlight a product that we just launched. It's called Future. We have 60% in Bitcoin and Ethereum and some other smaller coins, but these two sectors, payment platforms and smart contract platforms, are really the oldest and the longest standing sectors in the crypto space. So we have the 60% allocation there. And for the rest of the 40, we have growing sectors like AI, gaming, we have tokenization, where you really get the exposure to the diversified market. I was talking about the market cap weighted approach earlier. And what we found is that an inclusion for coins after the top 10, doesn't really make a difference in terms of correlation. So if you want a different exposure than to the top 5 or top 10, which is also already quite similar, you should go via an equally weighted basket or via a sector based approach.
Yeah, so I think you also had very recently indirect advertisements via the Bybit hack, right, for the ETP products, whether it's the ETFs in the US or the ETNs in Europe, right? Which I think are very suitable for, especially institutions. And how does it, what kind of role do the regulators play? I mean, I know that Switzerland is very open. We have now new BaFin rules in Germany, where basically the top 100 tokens coin now available. Does that change anything in your product pipeline? Because as of now, I know generally speaking in Europe, but also in the US, it's very single token focused. So do you see more future then for these baskets? Are they getting broader? Do we have more sectors then, more interesting sectors? How is that?
I think for the baskets, the breadth will, let's say, in the next 5 years, likely remain similar. So we won't see a top 100 just because of the correlation aspect that I touched upon earlier. But when you talk about the regulators and the regulatory changes, just to give you an example, SIX Switzerland and the FINMA just implemented last year a rule that every crypto asset that is listed on SIX needs to go through additional metrics. So what they did before is they required a due diligence on the coin. How does it work? What's the supply issuance mechanism? And this is part of our general DDQ anyways. So this was no surprise to us. But then they also added hard caps. So a cap of 500 million for the coins of market cap. Then the coin needs to have a minimum trading volume of at least 50 million on the past 30 days. And the coin also needs to have a certain age, which is also not surprising to us. So it didn't change anything in our product pipeline. And in addition to that, they really focused more on the custodians as well. So in Switzerland, they require a custodian to be approved by FINMA in order to have a product listed on SIX. I mean, you touched upon the Bybitech. I think this is very comforting for investors that the financial regulator in Switzerland really does have an interest in the security of the products. And with other jurisdictions like the US or the London Stock Exchange and the UK, with them opening up, this also gives a sign to the market that the market is maturing and that investors can have more trust and confidence in the financial products issued.
Yeah, no, it's absolutely important. I think it's also no coincidence that we have these massive flows in the US to the ETFs finally. I mean, it's also a very strict regulation so far. But I think you see also some spillover effects to Europe. Carlo, I know you're a derivatives expert, right? And we talked a lot about spot investments, ETP. How do you approach the crypto landscape from a derivatives perspective? What are investors demanding? Is it yield products? Is it covered call selling? Or how could I imagine that?
Thank you. So at AMINA Bank, we have a unique setup. We have a principal trading derivative desk where we take risk on the book. And we have quite a comprehensive range of hedging strategies and solutions. We also have a structured solutions business as well, so the two go hand in hand. But what we have seen a flavor of demand leading up until the bull run of last year until January this year was typically yield enhancement. Clients are typically sitting on a coin stack, wanting to monetize their holding. Or we've also had strategic exits. So we've had clients that want to exit at certain strike prices, and we've written covered calls, and we actually run this in derivative mandates. So we're one of the only banks that actually run mandates on crypto derivatives. And so a variety of strategies, to be honest. We have risk reversals where we can cheapen trades by buying puts but then selling calls. So it's really a combination that matches the client's view or the strategy that we determine upfront within the mandate. But then we also do derivatives on an execution basis as well. We have foundations that trade with us. They manage the liquidity of their treasury function, and they're sitting on their own tokens or other stacks, and we manage their liquidity within a mandate or on an execution basis. So from yield optimization to diversification, we've had clients that have actually rolled off out of crypto and then want to get back in, and we've optimized core spreads with risk reversals just to get leveraged participation. So there's a lot happening in the derivative space, more than I anticipated, to be honest with you.
But I assume that's very institutional driven. And do we speak of institutions as family offices or yeah, I mean, you're nodding here.
Not at all. So it's a mixed bag. So we have some RMs in the room that we work closely with. We have private clients sitting on 800 BTC, strategically wanting to deleverage and and roll off, and we did covered calls at matrices of prices and strikes and terms. We have foundations, as I mentioned, with some more institutional flavor, which is creating liquidity or hedging as well. And we have some asset managers who run mandates on behalf of clients of the bank that do short put strategies, systematic short put strategies. So we have quite a quantitative desk at the bank, and we do these quantitative strategies within mandates. Otherwise, clients have quite a variety of needs.
So, I mean, given that crypto is very, I would say, inefficient, it's less efficient than stock markets. Do you see more room for active strategies here, or is there equally demand for passive strategies or semi-passive? I know you also have an ETP product, for example.
Yeah.
Is that evenly split, or is there a trend going on at the moment?
Okay, sure. So we have a hybrid approach at AMINA Bank. So we have passive strategies, as you mentioned, the ETPs and our indices. And we have an AMINAX tracker. It's our flagship award-winning product. It's one of the easy, accessible, broad-based, capture the whole whack-a-mole, the whole market, crypto market. And one, it's a market cap and risk parity weighted ETP. And that's our flagship product. On the active side, we typically start with the same constituent weightings of our passive index. And then we have digital investment committee meetings on a monthly basis. The ETP, sorry, rebalances on a monthly basis. And then from an active management perspective, within mandates, within AMCs, we have asset managers that delegated the investment management responsibility to AMINA Bank via a wrapper being the AMC. And we have monthly digital investment committee meetings where we pull together our research analysts, our portfolio managers, and our analysts to refine our allocations. So it's a combination of both. But we start off with the passive constituent weightings, and then we apply fundamental analysis to overweight or underweight, and it goes through a proper process and committee meeting at AMINA Bank.
Yeah, that's interesting. I mean, generally speaking, I think most of the investors have really a problem. First of all, selecting the right coins, right? I think we all agree Bitcoin is a core investment. But if you ask investors, the number two is already, you can put a question mark. It was Ethereum. Now Ethereum is getting questioned. People were convinced it was Solana. Now everybody is hating Solana. And so, that's really the big question mark here. And I often hear focus on fundamentals. Yeah, and I think a lot of people don't know what fundamentals are in crypto. And I know, Dennis, that Bitcoin Swiss is doing something focusing on-chain fundamentals. And I think it would help here for this audience, maybe explain what on-chain fundamentals are or could be, and what are examples of points which have sound fundamentals.
Sure. I mean, so basically, if you think about how we always call it, right, TradFi, but in terms of equities, normal stock listed shares basically of a company, right? You always then look at the annual report, you see maybe the fundamentals, what did they produce, you have a net income statement, etc., right? But on the crypto blockchain, then you really have all this on-chain data basically available 24/7. It's live data of what's actually happening on the network. So be it how many people are transacting, how many people are sending maybe money somewhere, and how many people are maybe also then interacting with smart contracts. So basically programs on the blockchain, right? And on-chain fundamentals basically implies we can really see the economic activity, the health, and gauge basically how vibrant is a certain crypto asset currently. And now to give some examples, right, we also have that in our blue chip index, really have pre-screening mechanisms and say, okay, if there's not a certain amount of active users that send through their transactions and we can track it from the sending addresses basically, then this asset is not eligible, right? So we can really use on-chain fundamentals to gauge any crypto project. Are they active currently? What is the health? And also what's the activity behind it, right? And then some good examples are, of course, really, as I said, you can consider how many people are really active on it, but you can also consider how much is the transfer volume maybe. So not only are people active, but do they transact in microcents, or are they really sending, like in the case of Bitcoin, hundreds of thousands of dollars usually in these transactions?
Can I ask you a question?
Yeah, sure.
What is an emerging fundamental this is an ecosystem that is evolving every single day. What would you say were one or two emerging fundamentals that weren't here 2 years ago? Sorry to put you on the spot.
Yeah. No, it's an interesting one. I would say always the new on-chain fundamentals usually also coexist or co-emerge really with the new industries or sectors we have in crypto, right? So a couple of years ago, gaming really came up. Now we have real-world assets, right? So now suddenly we see someone like Franklin Templeton. They have their tokenized bonds or securities offering. They want to put it on Solana. So then suddenly the on-chain fundamentals are also maybe the real economic value of what's being tokenized or traded on a blockchain. So I would say the new on-chain fundamentals, they really prove themselves to be worthy with the new sectors and new ways of looking at things, right? Or let's say, for example, holder dynamics in the case of some social or community tokens, it's more important basically how many people are behind it. Whereas for something like Ethereum, it's more important how big are certain actors and what's basically the economic power and force behind them.
Okay.
Yeah.
Makes sense.
I mean, speaking of fundamentals, I think we also have to talk about coins without fundamentals. So you can guess what it is. It's meme coins. I think that was responsible for a large push last year, especially also in Solana chain. It was the meme coin chain. Now we had all these rug pulls, with Libra and the Argentinian president, even Trump issued a meme token. I'd like to hear your opinion from all of you. Do you think meme coins? I mean, I hear that it's attention tokenized and all that stuff, internet culture, but do you think it belongs into an institutional grade portfolio, or is it a separate bucket?
Yeah,
How do you handle that?
Yeah, no, it's a good question. It's also very controversial. We also had that when we set up our index, basically, will we include meme coins, yes or no? So I think there's definitely an investment case behind it, which is somewhat controversial already. And as you said already, yes, there's no fundamentals, but then also this sort of community memetics behind it or attention surrounding certain actual meme coins, and of course not what you said, some rug pulls or pure farm tokens that are basically issued just to get the money out of investors that buy these tokens. Then I think there is some merit to some of them, but that is a very select few. And I think that's then also the few meme coins that stand the test of time, basically. So the one that everyone probably knows is Dogecoin, right? I think also Elon Musk, he's always talking about it here and there. I think those products as a very, very high risk allocation for, let's say, the additional alpha in a product you can add. But I would certainly not blindly, let's say, set up a meme coin basket and call that diversification, because that's then also over diversification or diversifying into BS usually, right? So in that case, it makes sense to have a very few selective bets. It also then matters when do you diversify. So you do not want to diversify at a market top and then hold it for 3 years. You maybe want to diversify into meme coins and these social tokens that have active communities when liquidity is easy, when the bull market is there, and the crypto ecosystem is very vibrant. So there's a very cautious approach to it, but then I would say definitely you can include it in a diversified product, but to a limited extent, with the intent to not hold it forever and to a limited extent.
Yeah, of course. Look, I mean, I think the short answer, the narrative that we see at AMINA Bank is that it's now an institutional narrative with the spot ETFs, with you can see Standard Chartered, Morgan Stanley, all climbing in, and it's almost becoming an integrated landscape between traditional and well, it's an integrated landscape to having digital assets within a traditional portfolio. From an institutional perspective, I don't see the case quite yet. Sorry to be counter, but it's still from a because the industry is maturing from speculative trading to more institutionalized strategies. That's the way it's going. That's why Bitcoin has held its dominance at 60%. That's why value has been locked in the ETFs, and you haven't seen the rotation into Ethereum and then trickling down into a broader altcoin rally. Our view, maybe as a FINMA regulated bank, I have to say the right things, but we still see, I think the narrative in the future as this unfolds is it has to have a specific utility. And without that, I struggle.
Yeah, I mean, it's interesting. I think, I don't know if that's valid today, but until recently, Doge outperformed Bitcoin, right, since inception. So it's hard to grasp what that is, this mimetic thing. So how does 21 Shares handle that?
I think that's a very good question on how to grasp these things really, because I would say meme coin doesn't equal meme coin. And you touched upon Doge. Doge is the first meme coin ever. It was launched literally as a joke on a dog that is now dead. But in the meantime, a lot of things has happened. I did the research, and I was just curious what you can actually do with Doge. And you can do quite a few things. You can buy Tesla merch, obvious, because Elon Musk is a big supporter of Doge. But you can buy Microsoft products via BitPay. You can buy airline tickets on Air Baltic with Doge. And we see this increasing utility for Doge. We also see that they did some charitable causes. So they raised 30K for building wells in Kenya, all community driven. They sent the Jamaican bobsled team to the Olympic Winter Games 2014. And I think these are things where people are not necessarily aware of because everything gets put into this one meme coin scam bucket. Also, if we look at the fundamentals of Dogecoin, we can see that this is a disinflation. Oh my God.
Disinflationary.
Disinflationary, thank you, asset, where the inflation rate is set in the program. So every year, a certain amount of Dogecoin gets released, and with the increasing supply, the inflation goes lower and lower. Store of value. This is highly controversial of Dogecoin. One could say, yeah, it is a store of value, what you touched upon, of internet community. But given the disinflationary characteristics, maybe in the future, this will be a certain store of value as well, besides the internet community.
Yeah, so small anecdote here. We have a meme coin index, and Doge is a part of it. And sometimes you get a shitstorm on X where people complain that Doge is in a meme coin. That shouldn't be there. So,
Too much utility.
token. Yeah, so it's really, it depends on the perspective here.
I mean, I think the bottom line, what I'm hearing emerging out of this discussion is that meme coins have, okay, there's the headlines, and then there's potential for specific utility, and we can't fully predict, you know, it's disruptive. There could be a specific disruptive value there. And I think, so you're quite right, diversification requires a bit of allocation and to adapt to different cycles, but it needs that emerging property, I still believe.
Yeah, absolutely. So I think maybe we should focus on the more serious stuff. And the problem is that crypto is so narrative driven, and these narratives are very short term, right? We have this AI cycle, we have a meme coin cycle. Then also we had RWA and all that stuff. So Jasmin, what do you see as a maybe more sustainable sector or trend establishing maybe for this year or going forward, which has more traction than just for a few weeks? Or do we stay there and in constant rotation every 5 weeks or so? What is your opinion?
I think what you said about tokenization is very interesting because I do think tokenization along with stable coins will be something that won't go away, especially with the regulations such as MiCA or also the US changes. We see more and more institutions wanting to tokenize real world assets. If you think about it, what it is, it also makes sense. It makes the operations much more efficient. It gives you 24/7 liquidity, and it also gives a lot more investors the access to these tokenized assets. Alongside with the tokenization and the pro-crypto administration in the US, I think DeFi is something that will not go away. Because you really have a sustainable revenue generated from these DeFi protocols. And we hope that with the US changes, that this will also go more to the investor. And a third thing is also something that you mentioned, the AI narrative. I think it's more than just a hype, because if you think about how AI learns, it learns based on huge data models. What is the beauty of Bitcoin and all other cryptocurrencies that are based on blockchain? Everything's open source. So an AI model can learn incredibly fast and incredibly efficient based on the data on the chain, which then can be used to improve DeFi activities or DeFi protocols and also AI agents based on the blockchain.
Yeah, I mean, I think we have $650 trillion with a T off-chain on assets, and I think on-chain RWA, if you count stable coins into the mix, it's 250 billion, something like that. So there's a huge potential. And I think, Carlo, what is your opinion on this tokenizing thing, RWA. Is that a topic for AMINA, and how do you see that?
So tokenization, I mean, it's a major theme, and it's a very good arguments and points there. Well, I mean, we haven't seen the breakthrough that it's just that's the breakthrough it deserves. I think what, you know, for tokenization to be material, it has to have some form of call it major efficiency gain, faster, cheaper, much more features than the traditional systems, right? And not to write it off, I mean, you've seen BlackRock, you've seen UBS, they have tokenized money market investments, you've seen SIX issuing a digital bond. Great concept, but the adoption rate, unfortunately, has remained low. Where I think it could take off is it requires a bit of a catalyst. I think I've seen, you know, service tokenization come into play quite interestingly. I saw MasterCard, I don't know if you guys saw it this week, made an announcement by 2030, you will not have 16 digits on your credit card. It'll all be tokenized. Every single payment will be validated on the blockchain, security, all recorded. And I think that is the disruptor that I was talking about earlier, that I was alluding to earlier. You got that, and then you have that major efficiency gain, which could lead the way for tokenizing assets as well. And you don't know where this thing goes. It can really disrupt healthcare, financial system, information, digital security. So it's got big legs to stand on, but we're just waiting for that major efficiency gain. It's almost like Amazon. It was a bookstore. It now becomes this global powerhouse distribution. It disrupted everything. We need that kind of event, tokenization. But it absolutely, for me, and the way that AMINA Bank sees it, it's certainly something that we're waiting to see to happen, but it will happen.
That's interesting. I mean, if you think it through long term, and let's say by 2035, maybe we just have a wallet and we have our equities, our bonds, commodities, the crypto assets, the music NFTs, everything in one wallet. I question what is then a digital asset? So I'm running research for digital assets, but what is that then? So, and I know you work for crypto native companies, and I don't know if you can talk about it. I think are there long-term ideas then also to cover other asset classes, or do you think there will still be niches where you say we are focused on crypto assets? Because I question that all the time. What does it mean for indexes, for example? Do we need broader indexes? Do we have an all-country world, so to say, and digital asset which compiles everything? I know that's out of the box, but I think it's an interesting question.
What year are you in? 2,500?
No, I think
it's important.
10 years.
10 years.
I think people who are
it's certainly going that way. I mean, what we see at AMINA Bank is portfolios first have become unified, so just digital assets are blended now with traditional asset classes. The next question is, can I put this on the blockchain? Can I? So absolutely, it's most certainly trending in that direction. Whether you have one wallet in 10 years holding everything, could be.
I mean, it's just really a long-term thing.
It's a
long-term thought. So I don't think we have to worry about that today, right? There's plenty of room to focus on crypto assets, but that's always in my mind. And so I just wanted to hear your opinion here.
I don't think you have to tokenize everything necessarily even. I think a lot of things will always stay, let's say, non-digital in the real world. But it's always about the access. I think you mentioned also quite a lot in terms of tokenization and the access and what can come. But that's also then a very important point. I mean, the large majority of the world at this point has a banking access, but brokerage access is still almost non-existent, except for maybe the Western European part or the United States, maybe, amongst the other few. So I think the unbrokered part of the world is something like 80%. So in that case, the actual adoption, but also I would say, let's say the need, or as you said, the catalyst still has to be there for some of that digitalization or blockchain native access maybe to happen. But I think you do not always need the blockchain, which is funny to say because I'm actually a very big crypto enthusiast, right? But a lot of things you do not need to force always on the blockchain necessarily. A lot of things work great as they are, and maybe digitalize the access, but not everything will necessarily end up on the blockchain, I believe.
I think I agree with what you're saying, because like the equity market, it's super efficient. So I don't see a need for this to be on the blockchain. And I think we're still very, very early. I think we will have such a portfolio maybe, or such a wallet with everything inside the moment we don't talk about the blockchain anymore, because the blockchain itself is a boring concept. It's like it's similar than how does Wi-Fi work? No one knows, but everyone is using it. And I think when we reach that point in crypto, then we can talk about what is a digital asset.
Okay. Surprising to hear that from crypto native people. But maybe you're right. I also think it's a lot about yield, right? You want to tokenize bonds, and you have that on chain, and then your stable coins that they are yield generating. Speaking of yield generating, I know, Jasmin, you have a lot of staking products also out there. Is that high in demand? Because I always hear that in the US, staking could be applied for Ethereum, and that's the great game changer. We see much more demand. Is that the same here in Europe? Can you say that people want that? Is it a game changer?
If it's a game changer, well, I don't know. I think that needs to be decided by every investor themselves. But what I can say is that more and more investors are getting more into the crypto details. So more people are asking about staking. People are asking questions when the product is not staking but could be staking. We also see like great collaboration with the regulators and the tax authorities here in that regard. So, for example, we are reporting our staking rewards to the Swiss tax authorities. When you buy an ETP, you can profit from the seamless integration in your normal portfolio and have the staking rewards automatically reported to the tax officials. I think the more people are getting aware of it, the more it will be in demand, even more than now.
Yeah.
Absolutely. I mean, AMINA Bank, one of the in our mandates, and even just on an execution basis, we have many clients that have staked assets, and we write derivatives over it, so they're getting yield on yield. And it's now a common, how do we juice this thing up? And for sure, in fact, it's becoming the most traded product at the moment is staked assets with covered calls or short puts to get the additional yield.
Yeah.
They want the base yield, as you've said.
Or even like wrapped assets.
Yeah.
That you take your staked assets and wrap them so you can still use them in DeFi applications. That's really something where we notice investors get more up to speed with what's happening in the crypto market and how things function there.
I think what's maybe also important to point out there on top, it's not only, let's say, the actual yield for staking, but oftentimes a lot of crypto assets, for those who don't know, you actually have fee sharing models. So it's, let's say the company pays a dividend for all its customers. And if you're not willing to open your hand basically and say, hey, I'm willing to take part in the actual yield that's being distributed or fees that are being shared on, let's say, certain DeFi applications, right? Then you're actually also missing out. So you're oftentimes also getting actually diluted if you're not managing a yield product or not getting the staking reward. So I think that's maybe also what caused less success in the launch of an ETH ETF, because you have your ETH, but you do not get a staking yield. So basically, there's a 4% annual dividend, give or take, and you're not being allocated that dividend. So you're effectively being diluted by 4% annually. So not getting the staking yield, so the new issuance, or let's say the anecdotal Bitcoin mining issuance, so not the newly issued ETH you're getting, but you're also not even getting the network fees and the let's say revenue the crypto asset is generating. So there's even a dual-sided sword. So you're missing out on both ends if you do not have a yield product.
But you take on the risk, but then you don't get
On
compensated.
top, yeah. So it's even worse.
Yeah, I think we have to start Q&A soon, right? But I have one question left out of personal interest for my own portfolio. Of course, it's not financial advice, but what would be your top 3 picks besides Bitcoin, ETH, but also be an ETF or broader basket, anything else crypto related? Of course, it can be stocks, crypto stocks. So what would be
I'll go with my portfolio approach that I mentioned earlier. So I think I would put 60% in Solana, because I think Solana is still good. And I mean, Ethereum, Solana can coexist. We also have Apple and Microsoft with their operating systems. Then I would put 35% in Ondo, because they are taking care of real world tokenization, real world asset tokenization. And then for my asymmetric bet, I'll choose Dogecoin.
There's your meme coin answer.
It's just coach, right? It's a little bit
Yeah.
low, yeah. But maybe you should buy the meme coin.
It's a cool satellite approach.
No.
So Dennis, what's your super portfolio?
Yeah, it's always funny because people ask me that, and then when I talk privately, they know that I'm quite deep maybe into some altcoins or really crypto native, but publicly I always say actually what you don't want me to say, so Bitcoin and ETH. But I would actually go so far as saying, sure, stay in Bitcoin, right? But we also do not know exactly which assets tend to survive in one or two cycles. So if you really want to survive, let's say multiple cycles, diversify a bit broad, I would actually stick it rather to sectors and sector winners. And I think what's definitely going to perform well in the future is still the DeFi sector. We always need liquidity, we always need yield and financial vehicles to trade on the blockchain. We also always need layer ones and infrastructure. So I would definitely say, do not rule out that sector and go with whatever is the leader, which currently is the 60% Solana weight and maybe some Ethereum currently as well. And otherwise, I would say sectors that are really high potential currently are really real world assets and AI for sure as well. So go, let's say, with the leaders there and the market dominant players in those sectors. And usually that evolves anyways after 1 year. If you look again at a sector and who's the market cap dominant player, the picture is a totally different one. So I would say stay flexible and see how the cycles evolve.
Some not so serious stuff for us.
Okay, that's the serious stuff. I'll go on with it. It's fine. For full disclosure, this is not supported at AMINA Bank. We don't have this coin.
It's just recorded here.
Pip, I haven't know how to pronounce it. This seems like an interesting meme coin. It ties in the AI narrative. AI
Which one is it?
PEPE.
Pepe.
Pepe. South African accent, can't get it right. Yeah, it ties in the AI narrative. It's creating AI content. Speculatively, but yeah.
Okay, that's cool. I would say we can open a Q&A. Are there any?
I'll let you choose. So if anybody has a question, please raise your hands and
Yeah.
Martin, right?
Okay, yeah, go ahead.
So I got a question. So basically over the past month, the market's going pretty sideways. So if I have a client who just recently got into the market and is asking me, I would like to get returns now instead of just watching the market daily, seeing where things shopping centers. What would you maybe propose, or what solutions are there? And then the question to Carl.
Question for the recording.
For the recording, so,
I can repeat the question.
yeah.
The question
Because
was,
I didn't fully understand it.
Sure.
Yeah.
And is the client starting position native crypto or is it fiat?
Bitcoin.
It's Bitcoin. Okay, so the client's sitting on Bitcoin. The market is consolidating, going sideways or slightly trickling down. What strategy would AMINA Bank propose for this client? So, I mean, this is a classic discussion that I have every single day with clients. We have a derivative book, and for us, clients typically want to, sweat their assets. Bitcoin, you can't get any staking. So typical, we run quite a few covered call mandates where we have different risk buckets and we lump the strategies together. So one of the proponents I would propose is basically whatever their benchmark is, we would run a discretionary systematic covered call strategy, but with discretion. And this week we put on no trades. That's an example.
Okay. Any additional?
I was also about to say this sounds like a perfect case for a covered call strategy.
I would say zoom out, check where you're in the cycle, check the market risk, and maybe double down on the prices if the market positioning looks favorable. But yeah, maybe. No, but it depends also, of course, on the pattern or let's say the risk profile, right? How long is the investment horizon? But usually, I think if you're already in Bitcoin, then you want to hold it for a bit longer. So consider if you want to rather double down, as I said, buy more, or if it's time to maybe get a little bit out of the market. And currently, the time is not to get out of the market.
Getting more risky, I like that.
Connected to this, do you still believe that the price will go to 180 this year, according to the outlook report?
Yeah. Yeah, but maybe for some background. So I think we all said that in our recording for the outlook, and I said I think the price definitely going to end up above 150K this year. And then the outlook target, which we also iterated or first issued, I think 1.5 years ago at this point, was 180 to 200,000 for this cycle. And actually, the funny thing is, as you go throughout the cycle, the magnitude becomes smaller, right? So once you're already at 100,000, then it's just an 80% move, which now for the traditional portfolio or something like the S&P sounds exuberant, right? But if you look at past cycles, and usually Bitcoin tends to 10, 20, 30x from the cycle bottom. And of course, that's a total bubble at the end of that cycle, right? So we have our on-chain risk metrics, we have price risk metrics, and really see them all flashing red, and it screams get out of the market, right? But in terms of what we see in the market and the potential that we can have also then once general markets ease or more liquidity flows in the system, I think it's still relatively likely that we end up in those numbers or digits. Fingers crossed, I see here for those that don't see it. But actually, I think it's quite likely. And also to be fair, in past cycles, Bitcoin has really been led by let's say, hype or a lot of new market participants entering, but also liquidity increasing. And if you look at all those models, and currently Bitcoin has been rallying purely off fundamental changes. So the ETFs, the new administration, everything has been easing the market. And actually Bitcoin should have performed worse, you could say. And the good performance was due to fundamentals. So there was no hype yet in the market, which sounds funny, right? Because Bitcoin was at 6 figures. We dreamed of that maybe in 16, 17 already, but the hype in the market was not even there. And we traded at 100,000 relatively easy based on fundamental improvements for the industry. So
I mean, it gets good tailwinds. You have geopolitical risk being relatively resolved.
Also,
you have inflation data coming out. Tariffs could be well bedded down and actually have a very small trickle effect through. I mean, then you have that tailwind effect with the fundamental, the fundamentals. So stick to your guns.
Yeah, I hope so.
You have options on Bitcoin and crypto, so
yes,
all options.
Yeah, it's okay.
Okay.
Yeah, and exotics as well. Yeah, and we have I mean, thanks for the question. So we have a principal trading desk where we clients take on counterparty risk of AMINA Bank, and we do a combination of strategies using the vanillas, and we also have an SPV that you have no credit risk to AMINA Bank, and we issue exotic structured products, which are really just the ported products from the traditional world: accumulators, decumulators, sharp notes, capital protection notes, order calls, etc. So we have it's a beautiful thing about working in a bank in an investment solutions business. You have a comprehensive suite of products and services to cater from retail all the way to asset managers. I mean, we're onboarding some funds that are going to be managing derivative strategies plus structured products and crypto within their own fund. Yeah, and we're going to be coming up with our own AMC, which will be a market neutral short ball strategy as well. So
Thank you.
you can chat afterwards as well.
Yeah, actually, I have 2 questions. So one, which is, you say Bitcoin would be whatever, 150, 180, which is the formula used to determine this price? How do you attribute the price to the coin? I mean, the classic is discounted if you cash flows, but
yeah,
coin, what do you?
Yeah.
Second question is, what do you need any other coin than Bitcoin?
Now the second question is maybe a bit more tricky, even though I would say it's maybe also easy to answer in some regards. But I mean, how do you measure it, right? You, of course, do not have any cash flows. You cannot say it's like a business that generates revenue and people pay for it. So how do you model it, right? And the best way how to model it is basically really network effects and how also then certain internet stocks or internet networks have been adopted. And then if you zoom out on Bitcoin, you really see that perfectly on a chart. You see that logarithmic exponential trend, how it's basically growing and being adopted. And you could have modeled it from 2013 onwards already, and you would have basically been pretty much in line of how it's been adopted. And you see that also it's been played out that way for any internet stock. Going now beyond Bitcoin, it's also been for Ethereum, actually, how it's really accrued users, but also drove revenue. It's very similar to Meta, to Microsoft, to any other network or internet network, how it's been adopted and yeah, basically found its place in the market. Yeah, so I mean, if you then look into those parameters and really dig down into the data, then you would really come up easily with a price target of what I mentioned earlier. And that's then even on the, let's say, average to moderate end. So in a pure bubble phase, then all the models would still not flash anything if you go to 300,000. But that's then really taking a lot of liquidity and hype in the market, and you will, of course, come crashing down. The second question is, yeah, of course, you can say you don't need anything other than Bitcoin. And of course, you need Bitcoin, but there's still a lot more to crypto than just Bitcoin. So of course, Bitcoin, we don't need to debate. It's very important. It will always be the most important crypto asset, but you still need crypto infrastructure. You still have a lot of other functionalities such as DeFi, AI, real world assets. So they all have their place and their merit. So the question is then not do we need anything else but Bitcoin, but Bitcoin is, let's say, the Google that drove the whole internet topic. But then we have all the other internet companies that we still need, use, and are happy that they're there, and they're disconnected, they're independent from it.
Maybe to make some comparisons to like real world examples, you could see Bitcoin as an emerging store of value. So a method to value Bitcoin could also be to compare it to gold, because they share same characteristic. They're both scarce, they're both divisible, they're both have a limited supply. Although you can say Bitcoin actually has a limited supply, and one day we will go to Mars and mine gold there. But then, as you said, we have the infrastructure, we have the operating systems, the Apples, the Microsofts, the Linuxes of blockchain, which is Solana, Ethereum, Sui. We have apps like when you go on your phone that is running on an operating system, you go into the app store and buy or get different apps. And we have the same on the blockchain. We have accelerators that make blockchains more efficient, the infrastructure layers such as Arbitrum or Optimism, which are on top of Ethereum. So there's really a whole ecosystem, and I wouldn't say like a blockchain is a blockchain because they serve different purposes.
Whole portfolio. I would probably stick with traditional metric, because you now said just for the whole portfolio, right? I think something like traditional, also Markowitz portfolio optimization, whatever, it doesn't work that well usually for crypto, right? So you should take different approaches. And in terms of risk, I would say usually we're in crypto because we want the alpha out of it. So I would say stick to the upside volatility, which probably leaves in terms of TradFi metrics, maybe Sortino ratio. But it doesn't make sense to really analyze the volatility or the drawdown, right? Because you're in it for those exuberant performance returns of maybe a 10x, and then you scale down the position again. So I think upside volatility and risk is what you want to consider, but not the drawdown maybe.
But you can use the drawdown and negative volatility measures as well if you are just having crypto as part of your traditional portfolio. And what you will actually see is that the risk return performance is much better. And you're just increasing the volatility minimally with like a 1 to 5% allocation, but your reward is really getting higher.
From an efficiency
Yeah.
perspective, yeah. From the back.
Maybe also another question on the on-chain data. So there's kind of a technical analysis, a qualitative analysis, also on-chain. How important is the on-chain part?
I would say it's actually the most. Yeah. I mean, let's stick to Bitcoin because it's always the best to gauge the market, right? And then I would say the on-chain data is almost as important as the general fundamentals in the world or liquidity or price data. But I would say it's definitely very, very important. So if you just want to basically gauge the risk of Bitcoin, let's say as a crypto asset, then you can use it with almost the same accuracy just based off on-chain data as if you use price risk or use liquidity in and outflows. So the result is ironically almost the same, even though you come from a totally different standpoint. And I would say that's also the beauty of why on-chain data works and is so important, because you come from a totally different angle, but you basically end up with the same result in the end, purely based off on-chain metrics. So be it anything like the realized price. So basically when was the asset, Bitcoin in this case, last traded, and what would be the implied market cap based just on when it actually traded, because we can basically then say, at which price did the stock trade and what is the company actually worth based off the trading price in the market. And a lot of other metrics that are similar to this work perfectly well. So you can almost live entirely off on-chain data to really get your way around in crypto.
Yeah, maybe I can comment on that because we have also an index focusing just on-chain fundamentals and active users and fees. And while it doesn't necessarily perform better than a normal market cap weighted index, I think it gives you some protection that you at least are invested in tokens which are used and which have economic traction. Yeah, they are users paying a fee for the service of this protocol. And I think longer term, I wouldn't say necessarily it's a quality signal. Some researchers doing quality assessments via these on-chain fundamentals, and I think it's too early yet. We don't have enough time series, but at least gives you some confidence that you're not stuck in protocols which are just dying. And so I'm a great fan of that, but we definitely need to do more research on this. Yeah. I see another question. Do we have some time left?
One more, I think.
One more, okay.
Okay, talking about diversification, what do we think about real estate tokenization? There RWA.
I mean, I think that's the base use case that should have taken off, right? Property rights tokenized. Yeah, I mean, I can't comment further. It's something that I would have thought would have been really one of the major efficiency gains, to be honest with you. Fractional ownership. I don't know if you have anything insights.
Fully agree. I mean, you want to basically tokenize what's illiquid, right? Because the benefit of tokens and small units is basically buying a share of something you cannot afford. So it's basically the decentralized crowdfunding version. You can buy a token on a Sunday evening from your couch, basically, and get invested in real estate or a part of a Picasso, anything you basically want to tokenize and make small fractions of on a blockchain. So as you said, start with what's obvious or where it's the best for efficiency gains.
Yeah, maybe a point to this. Maybe we will see it in the next 2 to 3 years. Maybe we go with the bonds first and everything, because bonds is like a more well-known asset class. Real estate is still like an alternative asset class. So I think it will come definitely, but at a slower pace.
Yeah, thank you very much.
Let's get
Thank you to the panelists there.